Hello, my name is Carl Johnson. I'm a certified financial planner for Arrow Advisors right here in Madison, Wisconsin. I'm doing a series of topics. This one we're going to do today is on personal insurance coverage. If you have any questions or would like to contact me for any reason, you can see my phone number and email on this slide. Here's my disclosure. And here are the insurance items that we're going to discuss today: property and casualty coverage, disability insurance, and life insurance. Just a note, disability insurance also has a separate presentation that specifically goes through disability insurance. I get more questions on disability insurance coverages from residents and fellows than any of these other insurance questions that we go through. So I thought it was worthwhile to have a completely separate presentation to go into a deep, detailed explanation of disability insurance and what someone should look for in that coverage. Property and casualty insurance. This includes auto insurance, homeowners or renters insurance, and umbrella policies. This insurance not only protects your assets, such as your automobile, your home, the contents of your home, etc., but also has a liability protection. Umbrella policies are exclusively liability insurance coverage that sits on top of your auto and home liability coverage limits. Most auto and home policies have a liability limit somewhere around $250,000 to $500,000. Umbrella policies come in increments of $1 million. A $1 million umbrella policy, the cost is roughly in the ballpark of $200 per year. And each additional unit of $1 million that you buy on an umbrella policy costs less than the previous unit. So a $2 million umbrella policy does not cost twice what a $1 million umbrella policy does. General insurance guidelines for umbrella policies is to have roughly 10 times your annual income in coverage or 1 times your net worth for liability coverage. So somebody making $200,000 a year, 10 times that is $2 million of liability coverage they should have. I tend to find most people that I meet with have homeowners and renters coverage and have car insurance. But very rarely do I encounter somebody that has an umbrella policy. As a resident and fellow, if you were to get into a lawsuit, most of you probably do not have assets that exceed $250,000 or $500,000 today. Your biggest asset is your ability to earn an income. So if you were to get in a car accident, get sued, it is possible that if you cause the accident and cause an injury, that the lawsuit could result in somebody garnishing your wages. In America, it tends to be the more you have in terms of income or asset, the more likely it is somebody's going to want to take that from you. So I strongly recommend, as an income earner, that you have a liability policy. Disability insurance. As I mentioned in a previous slide, your biggest asset is your ability to earn an income. Disability insurance pays an income benefit if you are sick or injured and not able to work. I believe that everyone who is a resident or fellow that can qualify for an individual disability policy for health reasons should have one. The question is, when do you get it, from where, from what company, and what features and riders do you want to look for? All of those questions will result in how much is the policy going to cost. As I mentioned in a previous slide, I have a separate presentation that specifically goes in great detail disability insurance, policies, riders, and companies. So I'm not going to spend a lot of time on that topic for this presentation. Life insurance. I get some generally common questions on life insurance. These questions are: when to get the life insurance, how much coverage is needed, And what kind of life insurance should we have? Term life insurance versus permanent or a cash value building life insurance. I'm not going to cover a lot of the what kind of life insurance because this presentation is supposed to be held under 15 minutes, and that's a topic that I could go through for longer than just the 15 minutes. But I will say, for my recommendation, for most residents and fellows, term life insurance is the lower cost way of acquiring life insurance, is what most of my clients that are resident fellows start with when it comes to a life insurance plan. When to get life insurance. The younger and healthier you are, the less it will cost and the easier it is to get. The assumption that we'll always be healthy and can always get insurance is a risky assumption. Most of the people that I work with are young and healthy, and most of those people assume that they're always going to be young and healthy. The how much question is the most important question on life insurance, and is going to be the topic that we spend the most time on in terms of the life insurance. There are generally two methods of determining the answer to the how much question. Method number one is needs-based. What a needs-based does is it focuses on what the beneficiaries would need to get by. These questions can be such things as pay off the mortgage, set aside money for college, what does the surviving spouse need for income? It involves a lot of guesswork, and the numbers may have to be updated as they change. Nobody has any idea generally where their 3-year-old is going to go to college or how much it's going to cost to send that 3-year-old to college 15 years down the road. Also, mortgages change over time. People upgrade their houses and buy bigger houses. But it's a very common method of acquiring how much life insurance is to go through a needs-based approach. The second method is the way that I like to do it and the way I feel is appropriate. Method number two is buying the replacement value or a human life value. This is buying the insurance amount that replaces the value of the asset that is lost. When you break down a person's ability to earn an income, the hard numbers and facts is that they are an asset that generates a future income stream. All other insurances pretty much are sold upon the asset value that is lost. For example, if somebody has a $300,000 house, when they buy insurance for that, they buy a $300,000 replacement value. So if their house burns down, the insurance company will rebuild a $300,000 house. Very rarely, if ever, never on purpose, does somebody insure a $300,000 house with a $100,000 policy, and then their $300,000 house burns down and they receive a much less home in its replacement value. The next couple slides we're going to go through are going to demonstrate the value of a lifetime income for a young professional and the amount of insurances that it would take to replace that kind of income. The annual income in this assumption is $200,000. So you can see annual income as an inflow, $200,000 value, growing at 3% for years 1 through 35. So this would be a 30-year-old making $200,000 a year, getting cost of living pay increases until they're 65 years of age. The annual expenses, which is an outflow, is $170,000 a year, growing at 2% all the way to age 90 or 60 years. This assumes that the person making $200,000 a year saves 15% of their income. You can see the mountain chart starts very little and then over time grows up to be a significant value of money. Then when they retire, they spend that money. It would be a good scenario if somebody making $200,000 at age 30, retires at 65, passes away at age 90. With no income and having expenses and no insurance, it's going to result in a lot of negative numbers. The next couple slides I'm going to go through some different insurance amounts to show what that would do if the spouse and surviving children want to maintain the same $170,000 standard of living that was enjoyed if the earning spouse were able to work the entire 35 years. On this slide, it's $2 million of life insurance, 10 times the annual income of $200,000. If the surviving spouse and children and pets and whatever is left behind tries to maintain the same $170,000 standard of living, there is not sufficient assets on the $2 million to do that. And this assumes the $2 million earns 5%. Here's $5 million. You can see $5 million earning 5% replaces the $170,000 of income. And it doesn't do it to age 90 in flying colors, as that mountain chart's getting pretty small out there at age 90. Life value replaces the value of the asset that's lost, which is the person's income. For a 30-year-old, 25 to 30 times income is what it takes to replace the income stream. A lot of people that I talk to feel, or they think, if they wanted to have $20 million of insurance, of life insurance, and was willing to pay the premiums, could get whatever amount of insurance they want. And then they have the thought that I'm worth more dead than alive. That's impossible. Insurance companies will not over-insure somebody because there's an economic value of somebody getting up and going to work every day, and that's the value that can be insured. Not all my clients own their human life value, but I do feel like it's my job to tell people what's available to them for insurance, and if they choose to do less, that's okay. It's their lives, it's your life, it's their surviving spouse, it's your surviving spouse that has to live on the insurance proceeds that are left behind. I just find that when somebody is young and healthy, getting more life insurance than less doesn't generally cost that much, and it's not that hard to do, and then you always know it's there to protect the ones that you love. In summary, nobody enjoys paying premiums on something they hope they never use. This applies to the life insurance, the disability insurance, the car insurance, the umbrella policy, health insurance, pretty much any insurance policy out there that you're paying for. You're doing so hoping that you never use that policy. When you get an umbrella policy, disability insurance, and life insurance, I would recommend that you buy either the most that you can get or at least the high side of your comfort zone. And your comfort zone can be either what you mentally think you should have, or it could be in your budget. So $5 million of life insurance on the previous slide, maybe budgetary wise, that's something you're just not willing to do. But doing $4 million obviously is better than doing $1 million or doing $3 million. Push yourself to go with a little bit more coverage than you want if you are unable or unwilling to do the maximum amount of insurance that you can get in any insurance policy.